Let's see. So come on in. We just opened the door. James is the first to arrive. That's a great event. Hey, if you could, as you come in, it's going to be a small group today. So if you could, go into the chat box and put in what city you're in, it'll help Vern and Kirk kind of know who's in the audience, and we can direct the conversation more to you. Yeah, there's David. Fantastic. Let's see where people are coming in from. Got Boston. Very good. Richmond. Excellent. So we'll get started just 1 minute after the hour and kind of see who comes in. You're gonna have lots of chances to interact, and we're really gonna pull back the veil and kind of show some some quick home runs that we use in the growth CFO world to improve cash, and we do that through our partners. Vern and the other Kirk who are on the call. So it's good to see everyone here. Okay, this will be a good interactive group here. Okay, improving cash. I don't know if you guys read Jeff Bezos' work in the Amazon world, but he got it right. If you got to make a choice between GAAP accounting or maximizing cash, choose cash. It'll get you through. We'll touch on some of that. So Vernon and Kirk, are you guys ready?
Yeah, looking forward to it.
Great. I'm gonna launch here. Just by way of introduction, my name is Kirk. I'm the CEO of Foresight CFO. In addition to leading Foresight, I teach financial management at Georgetown for grad students. Kind of, how do we complement their expertise to do even better? I'm the husband to one and the father to two sons who are both Army officers by way of West Point. So I got to mention that. We're really proud of them. And the topic today about improving cash flow. I mean, Jeff Bezos got it exactly right. From the very beginning, when he started his journey, he spoke about if he had to choose between GAAP or optimizing cash, he's going to put cash first. So at Foresight, we work side by side with CEOs, and we do this through growth CFO and accounting services. And when we first start with clients, that first 3-week project, step one, we're looking for impact. We're looking for an immediate wins. How can we, in that first 3 weeks, put so much more cash in the bank that literally it pays for years of services with us, where the CEO feels so smart for taking that step and getting started with us. And our secret weapon, I'm going to reveal everything today, right? It's Vernon and Kirk. I mean, they have capabilities on how to, from the existing business that is doing well, how do we get additional cash, which, for every dollar of cash, you're increasing the value of your business 3 to 6 times, right? So I'm really happy to introduce Vernon. He's our go-to guy here. Vernon, why don't you tell us a little about your background and what we're going to cover today?
Yeah, so Vernon Brokke with the Brokke Group, and we're strategists that help companies and CEOs to improve the value of their business. And as they do that through some of the tax savings and credits, as well as you build the business and you look to grow that, we help you in cutting costs and being able to improve your bottom line, so that when the event that you do exit your business, we are able to help you with our expertise that we have developed. As Kirk McLaren has mentioned, I come with over 3 decades of business experience, both with small companies and larger companies. I own 13 Jackson Hewitt tax franchises and other franchises. So I help advise business owners in improving to increase their ability to be able to grow their business and grow value in their business. Yeah. So one of the areas that we're going to have 2 webinars. One of them today, we're going to be talking about some very exciting kind of opportunities for you to increase the value of your business in a short period of time with little kind of interaction to get it done, to improve the value. But next time that we're going to be talking about, and I just want to mention it briefly, is a deferred sales trust. And it's the ability to defer capital gains. And as many of you know, the current administration is looking to increase the capital gains tax and taxes all around. So if you can defer the capital gains on the sale of a business or the sale of a property, or maybe publicly owned stock that you have, even your personal residence, the deferred sales trust is a tool to be able to utilize to improve your ability to get a return on a monthly basis for 10 years at a time, and then be able to extend that for another 10 years, then another 10 years, so that you're creating a generational kind of tool that allows you to pass that on to your estate. And the government's going to let you use their money, let's say it's $1 million, at no interest and no period to pay it back. So we'll talk about that the next time, but if there's any interest, we can talk about that now. I mean, we can, just give you an overview of it.
I think, I think deferred sales trust is a great topic, for a full webinar, Vernon, because I mean, with the proposed tax changes, it's pretty significant. It was good before, but even more important now to know, at different points of the business, personal assets, business assets, what tax strategy could really make a lot of sense. So I would definitely want to jump on that with you for the next webinar. Yeah,
we will definitely do that. But now what we want to do is introduce you to Kirk Canole, who is he's a partner in, I guess beforehand.
Even before that, let's do a quick poll just to get kind of a read of the folks in the room here. And your responses are anonymous, but we'll get a feel for the size of the companies in the room. That'll give Kirk, a feel for what types of kind of immediate cash impact, what types of approaches might be most suitable. So we get we're almost at the 50% mark. If there's one more person that wants to answer, good. We're at 57. I'm gonna keep the poll open for just a moment, and then I'm gonna close things out. I'll share the results, and then we'll go from there. Okay, so good, right? 71%, fantastic. Okay, there we go. Share the results. So it looks like from a size standpoint, where everyone is at $0 to $5 million size, that could be instructive on what type of cash opportunities we have. And then this is always interesting. Like this year, 2021, do we expect revenues to increase, decrease, or stay about the same? It looks like almost 70% are coming out of the gates pretty good this year, expecting an increase, and 17% are looking for something decreasing, and the matching 70% are about the same. So that's an interesting read. Appreciate that. Okay, now.
Yeah, so I want to introduce to you Kirk Canole, who is one of our strategic partners that has helped companies like WD-40, and other large companies that have he's improved their value immensely, and increased the value of their company within a very short period of time. So without further ado, I'm going to introduce Kirk Canole.
Yeah, I'm going to give you the power, Kirk, to screen share and keep us going.
Wonderful. All right, so I should have my screen sharing with everybody in just a moment. My name is Kirk Canole, partner at DCI Solutions. Excuse me, I trust my screen is available visibly to everyone.
Sure.
The goal is to work with any kind of company anywhere doing anything, and regardless of the SIC code, regardless of the type of industry you're in, and regardless of how much consulting you've already had done previously, to increase the cash flow, profit, equity value 10%, do it within a day of the owner's time and energy. So if you've got a company that's, let's say, worth 50 million on Monday, it's 55 on Friday, but it might be a smaller company with, let's say, $300,000 of earnings. That would be a pretty small company. Well, we might be able to add $30,000 to your earnings with a couple strokes of the pen. But as it says here, companies of any size realize average gains of $1,000 to $4,000 per full-time employee. I spoke with a woman who is a contractor. She is part of the 5G explosion in doing installations of 5G towers. But currently she had, I think, 7 people on her health insurance plan. And I was discussing with her yesterday. I'm not a health insurance broker, so I don't sell health insurance. But in this particular case, I said, you're looking at a savings on the individual, that is the employer's contribution of $3,000 per employee per year. And that's just for individual employees. And for the employee that has a family plan, the savings that you're going to experience, Mrs. Owner of the company, is about $10,000. So saving about $10,000 per per family employee, and then about 6 other employees that are individuals, it comes to about 6 times 3 plus 10, about $28,000 in savings for 7 employees. So not so bad. And we do this on a consistent basis for companies all across the United States. But the goal is to hit this threshold. We typically try to work with companies when they're at least 20 some odd people, but the employee retention credits allows even smaller companies of 8 and 10 to see some fairly dramatic savings that can get into the 6 figures very easily just on the ERC alone. The ratios or numbers that we'd like you to keep in mind again are this: 1,000, 10, 1. $1,000 minimum per employee per year, every year forever, world without end. And the second number here, 10, meaning once we get to $2,000, $3,000 gained per employee per year, we start to hit and exceed a 10% jump in the earnings of the company. And the total amount of time and energy it takes from the owner of the company is a day, one full 10-hour block of time, 600 cumulative minutes of energy. Everything else is details and delegation. All of that is summarized in the DCI growth chart. Again, I know that people that signed in on this are talking about having revenue from 0 to 5 million. But in general, we use 100 as a modular number, because if a company's got 600, they just multiply everything they see here by 6. And if you've got 50, you just divide by 2. So as it says here, a company with 100 employees will see annual gains of $100,000 to $400,000 per year, every year forever. And that means that if the employer chooses in his sole discretion to only take $200,000 and he doesn't want any more money after that, that $200,000 of sustainable bottom line gain means that by year 5, he'll be at the $1 million mark. By year 9, he'll be pushing $2 million. This big blue wedge of money is what we give all of our clients that like to work with DCI. And all that money will come from one place and one place only. It's called this cost efficiency dashboard. If you look closely, you'll see these 9 dials. And I'll let you take a quick peek at those. And then I'm going to ask you a question. Ready for the question?
I'm ready.
What do all these companies have in common besides being clients of DCI? Besides being clients of DCI, what do all these companies have in common? You'll say, I don't know. What does a not-for-profit school have in common with a publicly traded media company or a privately held restaurant chain? I don't know, Kirk. Nothing. The answer is you're almost correct. You're almost perfectly correct. The answer is they all have nothing in common except this dashboard. This dashboard is the only thing every company you've ever worked with, every organization, every for-profit, not-for-profit, and not making profit have in common. Every privately held and publicly traded company, what they have in common is they have cost for tax, insurance, freight, every one of these 9 dials that you see, and all of the sub-disciplines within any one of those single component dials are what DCI focuses our full-time energy on. So Kirk, was that a good start?
That's a good start. I think we could dive in some of the 80-20. Where does for most of us, where does the real savings come from? And the other Kirk, and he's serious. These are immediate for a day's work of the CEO time to line up the analysis, and then the expert does the rest of the work. It's real money and it's immediate, and then it keeps paying. You make these improvements, it keeps paying monthly, and as you scale your business, the benefit grows right along with you. So yeah, that's a good place. What do you think? Can we dive in kind of the 80-20?
I'll do this. As you'll notice, if you have your leisure to look at DCISolutions.net, as you hover over any one of these dials, an example pops out. The needle moves all the way to the right to the 99% range, which is where you want to be. And then when it does, an example of a before and after pops out so that you get to see different examples from 9 different entities where their gains were significant. I can think of I'll tell a short story and then gladly focus in on any of these dials that somebody wants to talk about. This is for a larger company. So again, it wouldn't be pertinent to a $5 million company, but just the other day, talked to a company in the medical services field and about 4,500 employees. The savings just on their health insurance is going to crack 8 figures. It's going to be over $10 million a year just on their health insurance. And the simplest rule of thumb, a thumbnail rule if you'd like, would be if you're paying more than $10,000 per employee per year as gross premium, that is employer contribution plus employee contribution, if that total amount of premium for a PPO, let's say, exceeds more than $10,000 per employee per year, and that means employees that are, some are single, some are married, some have spouse, some have only kids. But when you look at the aggregate, just in general, if your cost per employee per year is over $10,000, you absolutely positively are in the majority of CEOs. And you absolutely positively need to talk to DCI Solutions. Both of those are true. The gold standard would be to hit to $5,000 per employee per year. You cannot do that with outside help. You cannot do that strictly but by telling your CFO and HR director, work harder. You can't do that at all by relying strictly on your broker. I guarantee you that. So this particular company, excuse me, the CEO said, wait a minute, I'm in the medical services field. How do I not know about this? How did that happen?
Yeah.
And then I said, by the way, that's only the first. There's some smaller savings that are cumulative 3-year savings will hit 7 figures. So even though this is 10 million per year, over 3 years, the savings just on leased photocopiers is going to break 7 figures. And he uses Kronos, which just merged with another company, Ultimate, to become UKG. So for his payroll processing services on 4,500 employees, we're looking at about $450,000 per year. So if you do the math, that comes to $100 per employee per year, just on the payroll processing fees, just on the human capital management. And then, by the way, he was surprised. We said, "You, Mr. CEO, you're paying for services that don't exist. You've got a contract here and they charge you this much here. And of these major components, these major modules, 2 of the 3 were not deployed. You're paying for services in your company that don't exist." Like, how could this be? And then we looked at his real estate and I said, you have got a massive overcharge at 2 of your facilities where they have done things that look normal, but are outside the terms of the lease. So with the stroke of a pen, you'll scoop up $100,000 in refunds and you'll save 5 figures per year every year going forward on this facility here and that facility there, and then a smaller amount at another facility somewhere else. And then most of the other facilities are doing okay, but they have a full-time real estate department. And the CEO thinks, like, I've got a full-time real estate department. How could this possibly happen? And the answer is, it happens all the time. I like to use what we call our 10 and 10 tenant rule. Again, it's for larger companies, but once you have 10 properties or 10,000 square feet in any one property, and you're the tenant of those properties, then the 10 and 10 tenant rule kicks in, meaning you really want to have an external review by a company like DCI Solutions. And we will show you all the chicanery and mischief that might be going on, because out of 10 properties, it's very likely that 1 is being overcharged. And that overcharge might be insignificant or it might be very significant, but in either case, it's invisible. So our job is to make the significant visible to the client and then to prioritize what the top 5 are. Kirk, you asked earlier, where does most money come from, I think, or something to that effect.
Yeah.
So in this 9-dial dashboard, I gave you the example just then of a company with savings on payroll processing fees, which is a service, and on leased copiers, which is kind of a supply, kind of a service, and also on real estate, and then one on insurance. But in general, half of all the money in any company is found in the top row. So your company might be different, and 90% of all your money can be found in these middle rows of telecom, utilities, and supplies. But when you look at the average American company and you take the weighted average of all these companies, where does the money occur? Half of the money is here in the top row. The other half is in the bottom 6 combined.
And so those top three, so the tax credit, insurance benefits, freight, that's the I use the term 80-20. That's where the least effort, that's where you get the biggest result.
Right. And of course, we're doing a restaurant chain that's got multiple locations. We're talking hundreds. And freight for them is almost non-material. And because it's a restaurant chain, they don't have a lot of full-timers. They got a ton of part-timers. They have some tax savings, but where the phenomenal money is in their telecom. They're going to cut their phone bill more than half, save over $10,000 a year. Excuse me, $10,000 per month.
Yeah.
And actually upgrade their service and free up 10 grand a month. So you never know where the money will be. It depends on the type of company, but just in general, there's always savings on tax. There's often savings in health insurance and or property and casualty. And if you're an e-tailer, if you're doing $500,000 a year more in freight, we routinely expect that there will be anywhere from 7, 8, 9 to as much as 25, 35% reduction in the cost of your parcel, ocean, LTL, over the road, air, freight.
Yeah, it's massive. Let's dive into the tax, the tax credit area. I think that area is going to become increasingly important. Obviously, you know, there's stuff like the ERC going on, but the R&D tax credit could be important. And then, you know, the tax laws are about to change a bunch. And maybe there's some thoughts about that to build on what Vernon was giving us earlier. Can you take us through some highlights of, you know, the areas that we're going to
Sure.
like ours benefit from?
Yeah. So people say tax. Well, Kirk, I don't pay tax. I'm a not-for-profit. Well, not-for-profits pay tax, as everyone knows, if you think about it for just a moment. People say, well, I already got a CPA. I've got a big 4 accounting firm. I've got a blah, 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 fill in the blank. And I just have to listen politely and say, great. That means that there will not be any low-hanging fruit. But that doesn't change the fact that in tax, you have sales and use tax. So this example that you see here is from a surfwear company that had a big chunk of money to save every year going forward, plus a big chunk of money to scoop up from previous overcharges. Mm-hmm. So yes, sales tax, use tax, if you've got a lot of consumables in your whatever business you operate, their print, for example, software, consumables, those are examples where you find use tax refunds and sales tax savings as well. And then you have property tax, and then you have non-ad valorem charges that are not property tax per se, but they can appear inside the property tax bill as an add-on arbitrarily decided. You have utility tax, you have excise tax, you have state tax, local tax, federal tax. There's no lack of opportunities for us to generate and identify tax savings. So when we say tax credits, that's shorthand because sometimes it's not a tax credit. Sometimes it's an additional tax deduction. Sometimes it's a tax refund. Sometimes it's a tax apportionment play. When people are retiring their triple P loans, what they don't realize until probably never is that they're going to forfeit about 20% of their ERC credit or more because of the way they retire their PPP loan, which offsets the ERC. So what I've telling somebody literally this morning is we want to do the triple P loan for you for free because it's the only way we can be sure of maximizing the ERC. And if you say, well, I'll have my CPA do it, my guess is you're going to punt away 20, maybe 30% of the ERC face value. So when you have 100,000 ERC, it really should have been 120,000 or 130,000. When you got $1 million, you really punted away 200,000, 300,000. So it's good to make money, but don't lose the opportunity to maximize the money you make.
Yeah. Just to highlight, I mean, the ERC, you know, for those who may not be dialed into it, it stands for the Employee Retention Credit. You know, there's one available for 2020, and there's one available. Yeah, there you go for.
Yeah, this is an old one. You get the general idea. Go backward in time, go forward in time. So.
Just going to add, it's a massive benefit. I mean, the potential 19,000 per employee of taxes that you don't have to pay. And it's really, originally, if you had the PPP loan, you couldn't do the ERC, but that's been changed, right? Where you can actually do both. And so, well, it just really doesn't hurt to take a look and calculate, could be back of the envelope or come into the tool that you're going to show us at the end, to estimate what is, maybe what is this option? What is the potential benefit?
Mhm.
So,
Yeah. So we could happily talk about that. The first 2 quarters alone could be up to $14,000. And then last year, 5,000. And then if you look at quarters 3 and 4, just keep adding money on top of money. So the goal is to make sure that the PPP loans that you may have gotten are retired correctly. And then after those are retired, in a way that optimizes the ERC, we might be looking at well over $30,000 per employee per year. I mean, per employee cumulative. So this way, a company with 35 employees could clear a 7-figure gain if the PPP is apportioned correctly.
yeah,
Okay.
massive. I mean, whether they're growing or your company's decreasing, I mean, it's a direct infusion.
Yeah.
It could be the right, like investment money, capital to, restart the business, or if you're already growing to, where do you have growth potential to marketplace? And now you have the capital to make those investments, right? To get to even a better place. So pretty massive. It's worth, getting that first assessment just to see, what's available. And then yeah. I'll leave it there. But I know you got a piece at the end about freedom, so I'll leave it alone.
Well, no, but we covered a lot of ground. If there was any people that texted in any questions that you want me to field for now, or we just hit pause for a second and see if anybody in the audience had any questions that.
Yeah, it really, to put it, I'm going to give you the growth CFO perspective that what you and Vernon are bringing to us is, the what is there's an opportunity based on your existing business, which you're already doing, right? The what is you have a chance to have these cost savings, the 80/20s, those first 3 categories, but there's a total of 9 categories where you have some potential options to save money. And, dollar for dollar, when you save money, it increases profitability. Your bank account's filling up. But, what Kirk showed us in the first slide, not only does this impact your profitability, but the value of your business. I mean, roughly 6x for every dollar you save, you've increased the future value of your business by 6, so that you get paid twice. You get the income of your business, household income now, but also when you're ready to step back, there's 7 succession options. When one or more are right for you, and you decide which one to go with, and you step back, you get that big check if you have a more efficient business, right? So there's a question popping up in the chat box there, Kirk.
Okay, I saw. I wasn't sure if you wanted to screen that first, but here I'll pull it up and we'll all read. If you grew and had the PPP loan, but you grew, doesn't that rule you out? No, it doesn't. The question will be not, and maybe we should say grew. 2 things. Some people talk about growing their earnings, others talk about growing their revenues. So the employee retention credit, just to be clear, is based upon partly you have one slam dunk, and then you have a couple of other opportunities outside of the slam dunk. So for example, if you grow your revenue, yeah, that means you don't get the slam dunk, because having a decrease in revenue is a slam dunk for getting the credit. So if your revenue is down 20% or 30%, you've got a slam dunk. And then if it's over 50%, then you can actually pick up money from 2020. But in basketball, there's more ways to score than just slam dunking. Last I checked, Steph Curry hasn't slam dunked in quite a while. So the 3-point shots that you can make are disruption of supply chain. That would be the question that we would ask. We would make a case from what type of disruption occurred in the supply chain. Did you lose additional revenue that you could have had, but your customer had to move the order to somebody else because your supplies were stuck somewhere in China, Asia, and so you had to forfeit maybe a sizable contract? If that were to happen, then you could be eligible for the ERC on that basis. So it's not just strictly a slam dunk or not. It's, well, we didn't get the slam dunk, we'll go for the 3-point shot. And the disruption of the supply chain is probably one of the more obvious. It's not the only one, but it's just one of the more obvious plays for getting employee retention credits, even when your revenue is going up.
Yeah, the criteria is pretty open. If your business was disrupted by COVID, which most of us were disrupted on some level, including not being able to go to trade shows or travel or things of that nature. So it's a pretty, I mean, Kirk, I consider it a pretty generous criteria, or pretty open criteria. I mean, how are you seeing it?
I'm saying it that way. So what happens is people want to maximize, they should want to maximize their gain from whatever monies are out there. So the shuttered venue opportunity, the PPP opportunity, and of course the ERC as it's evolved over the last several months are all opportunities to maximize your gain. And what we tell our clients are, if you become a client of DCI, even apart from the ERC, you are going to see money. If I have you become a client of DCI, it's because I know in advance you will be gaining money. Now, you don't have to say yes to the money we show you, but we will be showing you some significant amounts of money relative to the size of your operation and your revenue. If you like the money, take it. And if you don't, then free country, don't. Best part about being America is not that people get rich. The best part is that people get free. So we tell our clients, you're always free to accept or reject the tax savings, the utility savings, the telecom savings, the treasury savings, the AP, whatever the savings are that we put on your desk, take them. Oh, and by the way, here's your ERC on top of it. That one-time hit that might be good for 10, 20, 30 something $1,000s per employee if we can get you qualified. And sometimes we can get you qualified. And then number two, after you're qualified, you want to get it maximized. And then third and finally, after you get it maximized, you want to get it documented. You want to be in a position to where when you do get 7 figures worth of ERC, that you've got all the documents in place when the IRS comes to inquire. So it's not enough just to know that they exist and to get some money. You've got to optimize, you've got to maximize. And then of course you've got to protect yourself, bulletproof, so that when the IRS audit comes, you're not losing sleep. So
Yeah, you definitely want to be audit and due diligence ready, no doubt, be bulletproof. How much of this requires companies to change providers or vendors, if at all?
not any change whatsoever. So the best part for many companies is the minimum disruption. You want to be able to save money. For example, if you've got an AT&T contract, and we say we know you're in the middle of a AT&T contract, you're 1 year into a 3-year agreement. AT&T ripped up the old agreement, issued a brand new one, and now you're saving $100,000 a year for the next 2 years, and you're not extending out the terms of your contract. Oh, well, how did you do that, DCI? This is what a CFO of a fairly large company said. How in the world did you get them to agree to that? We said, well, we're DCI. And this is what we do. So we do what looks to some people unlikely, maybe even impossible. We've done that on multiple occasions where the client says, well, I'm in a multi-year agreement. Well, great. Here's your new agreement issued by the same company that holds the paper on your old agreement. And look, the costs are lower. And look, it ends on the same coterminous date as the previous.
Yeah.
So this is what we do. We don't guarantee it will happen. We simply guarantee that there will be money that we bring up to the client, and then he's free to take the money at any time he may want.
Yeah. How do you, so you get a better agreement, you assess the opportunity for the things that make sense, and the client decides to pull the trigger, you get a better agreement, implement it. How do you make sure that there's follow through, that 6 months later we're seeing what we expected?
Yeah, there's 2 types of humans working in most corporate places. So let's talk about those 2 types of humans, okay? And I'm talking now about the kind that deal with money. The first type is that we'll call him the negotiator. The negotiator says, don't worry, boss, I got this. I'm going to negotiate the freight contract. Don't worry, boss, I'm going to negotiate the IT contract, the you fill in the blank. He gives a bunch of tough talk to the salesperson. The salesperson goes back to his manager. They go up the chain. They get approval. And with the right hand, they give all the concessions. That makes the type A negotiator so happy. He pops the champagne cork. He goes, look, I did it again. Aren't I great?
Mhm.
But he's done at that point. That's a type A negotiator. He likes to be boss. He likes to be in charge. He likes to lay down the rules. Do you think this guy ever spends a moment of his life looking at an invoice?
Yeah.
Not a chance. That's for bookkeeper Betty to do. So what happens is our hero pops the champagne, brags about his accomplishment, and goes off to his next major conquest. You think the vendor's not aware of this type of mindset?
Mhm.
You think the vendor hasn't seen this mindset 1,000 times before? So the vendor gives with the right hand, and then he takes back with the left hand. How does he do it? He says, here is your new contract. Oh, and by the way, here's my invoice. I'm going to give you with this new contract, and then I'm going to take it all back with my invoice.
Yeah.
Because the auditing invoice will discover, because we did this for one company, the CIO in this case said, hey, I negotiated a great deal with AT&T. I said, yes, you did. You negotiated a great deal. And you don't pay the contract, you pay the invoice. And the invoice doesn't reflect the contract at all.
Yeah.
What, are you kidding me? What? How could this possibly be? And I said, because people like you are everywhere. It's just the way companies are. It's the way the human race is. So
Yeah.
it's not enough to it's not enough to negotiate. You have to audit. Negotiate and audit are almost two different personalities, two different temperaments, correct? So DCI recognizes this, and that's why we don't just negotiate, but we have to audit and negotiate and audit. And usually after about 12 months, you've trained all the chicanery out of your vendor. He's given up on taking back with the left hand because he realizes every time he reaches his left hand into that cookie jar, the lid goes down on it. He goes, oh, shoot, thought I'd get some back. So after a vendor's been trained 6, 8, 12 months, the episodes of error go down. And it's curious that all these honest errors almost always go in favor of the vendor. Just a coincidence, I guess.
Yeah.
So what we do is we say, we're going to negotiate, identify, or help you negotiate. If you want to be front and center with the vendor, that's fine. We can be off stage writing the script and ghost writing your emails. You don't even have to talk to the vendor directly. Sometimes we just bring in the price and say, initial here.
Yeah.
But then we have to audit and guarantee that the pricing that went into place stays in place and that we transfer to the client our IP during that whole time. So he knows what to look for and no longer is as the other team slipping the puck past the goalie. Now the goalie's got that net much better defended, and they're getting it better defended because they have better knowledge. Simple equation for everyone to write down if you've got a piece of paper nearby is simply this: authority times knowledge equals control. We can't increase your authority. If you're the boss of the company, you're going to be the boss. But if we double your knowledge, we automatically double your control. And if we can double your control, that means you can get more productivity done with less exertion, more work for less work.
Yeah. Kirk, I want to highlight one where we've had a lot of unexpected success. I'm a CFO. I've been a CFO for decades. I've always heard about the R&D tax credit, but never really always thought it was kind of, you had to have, lab coats and test tubes to qualify for R&D tax credit.
Mm-hmm.
And when we started checking that together with clients and prospects, I mean, there's been a couple of, like literally a couple of home runs. It doesn't apply to every client, but for the ones who are developing software or doing something that does qualify, we frequently found like 6 figures of savings that recur every year, right? I mean, like $250,000. And there's one company that was pre-revenue. It was an investor-backed, PE-backed company, pre-revenue, and they qualified for over an $800,000 credit, and they're pre-revenue, right? So it's when somebody qualifies for a category, I mean, it's real money, real found money. So when you have these kind of successes, how do you get paid on that?
Well, it's always a matter of making sure the client wants the money. And that after as a matter of fact, the process is fairly simple. We find the money that is literally visible to the naked eye. We show the client the money in a discrete meeting 3 weeks after engaged. Then we get the money. The client delegates most of the work to DCI, but he has his staff involved at critical junctures as well. So it's a team effort. And then we have to count the money. and after the money's been verified, we have this outcome. The client will say, Kirk, I already do the R&D. Great. Kirk, I already do the cost seg. Fine. Mr. Client, I assume you're doing all these things. I assume you're doing everything. I assume there's nothing you haven't done. Now, with that in mind, I want to revisit the statement. Now I wanted to say a company with 100 employees will see annual gains of $100,000 to $400,000. Now that you've already done the cost seg, now that you've done the R&D, now that you've done the fill in the blank with whatever you feel like saying, this is the amount of money I want to give you an assurance of. And this way, people will never accuse DCI of going after low-hanging fruit.
Mm-hmm. Take it as far as you can internally, and then
take it as far as you can. When you're done, right? Assuming you feel like that's a good use of your time, and there's nothing more important for your staff to be doing than trying to become an expert in something that, frankly, they're not going to be able to repeat 1,000 times over because they got to get back to their day job. What we do is we have a team of people, 50 plus people, that all wear one hat their whole lives. You've heard of the one-hit wonders. These are the one-hat wonders. And these one-hat wonders are able to identify more money beyond what the client's already gained without detracting or in any way undermining the client's previous efforts. And when that happens, this big blue wedge of money you see, this is simply where we say DCI shares equally everything we produce for our clients. And then after 3 years, it gets even better because the client keeps getting 100% of his half, plus he starts taking 100% of DCI's half. That's why the blue doubles in size and goes to infinity. This is the equity value of the company long-term. This is the immediate risk-free increase in cash flow, substantial, immediate, without risk increase in cash flow and profit. So whether it's a for-profit or not for-profit or not making profit, there's now more cash on hand instantly within literally months, sometimes weeks of the client giving us the green light.
Yeah, and especially if you're only getting paid if there's actually more real money in the bank account.
Yes, it's got to be hard dollar in the bank. Can we count this money? So I gave the example of that restaurant chain. Is it $10,000 in the bank? And that was just on 33 restaurants. They've got 200, so we're going to do that, I think, 7 times over as we go from one brand to the next.
Yeah.
So that's what happens.
Yeah, Kirk, there was a question in the Q&A from Karen.
Yeah. I'll throw it out here. So the question from Karen, would you, if you're a franchise and your agreements are handled from the corporate center? So I understand the question that if there's a franchise and it's the franchisor that's doing the agreements, how does it play out?
Right. Well, the franchisor has a way of he skims money. And it's not just the royalty that the franchisee pays the franchisor. The franchisor says, oh, we got this great master agreement what you ought to participate in.
Right.
Sometimes you have to. Sometimes they simply encourage it. There's never time that they're not encouraging it, that they're not making a skim. And I would imagine that you could be in that wonderful position where your contract pricing is actually better than corporate. Far better than corporate. And it could be on any particular item. We've seen it on dozens of things. We had one purchasing manager call us one day from the national headquarters saying, how in the world did you get my division better pricing than corporate did? I'm the purchasing manager for this entire company, blah, 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 blah. I said, well, sorry, to tell you, we're just too successful. But for franchisees, you do have control over certain things in this dashboard. Certain things are not your prerogative, like where you buy your tomatoes and lettuce, perhaps. But there's a lot of things we can do even when you're under a contract with Cisco or US Foods that I think would, if you're specifically speaking a franchisee and you're buying certain services and supplies under some kind of prearranged agreement, we can have a separate conversation, but there's absolutely going to be money for that franchisee depending upon the size of the company that will give us an idea of how many thousands of dollars per year we could guarantee.
And that, Karen, that's a really good question because so what Kirk was pointing out, there's some categories that's your own discretionary spend, but it might be interesting, Kirk, as it played out, so for the franchisee who, for those categories where they have to purchase through the franchisor, are you able to audit those expenses and see what a fair price would be?
Oh yeah. So Karen, I don't know if you're speaking on behalf of yourself or a client or just a theoretical, but do you want to talk about what type of franchisee and what type of line of industry? Because that might help us talk about particulars that would be of unique concern to that line of work.
Yeah, home care, non-medical.
Okay, home care. So like visiting angels or something like that, where people come into your house. I was actually speaking to somebody about that. I think I've got a meeting coming up not long from now for a home care company with about 100 employees. And so franchisees that are doing home care, if you're paying the employee, paying their wages, I'm not sure, but I guess you might be, then you're probably looking at things like the WOTC federal tax credit. Because if you're having somebody come in to a home at 15, 20 bucks an hour, something like that, but you bill out at, let's say 35, but you pay the person maybe 15, 18. A lot of the $15 an hour employees that you might hire are going to make you the employer eligible for WOTC. That may not be rocket science for some of you, but the federal WOTC credit would be immediate pickup. There may not be a lot of operating expenses. When you've only got, let's say, a franchisee with 15 employees, 20 employees, there might be some more comp, but it's not going to be huge. You don't by law have to offer benefits, although you could. You might look at those. You probably, like I said, have the WOTC credit for your people that are making 15, 18 bucks an hour and less, plus the WTW benefit that cascades on top of the WOTC. There's really no telecom to speak of or utilities. You're in somebody else's house. Most of these other costs will be infinitesimal. The treasury might be interesting to see how money's coming into being paid to you and how you're dispersing funds.
Yeah.
I tell clients, if you're cutting paper checks, you should ask, what's wrong with this picture?
Mm-hmm.
You're a company and you're receiving paper checks. You should be asking, what's wrong with this picture?
Yeah. Hallelujah.
Yeah, very good. So there's a tedious loss of time and money intrinsic to the movement of paper. And so when someone says, oh, we got to watch our expenses really tight, I say, well, fine. Just don't let me see any paper checks going into or out of your company.
Yeah. There's a character kind of bring it home. So Karen, I would definitely say, get the health check, and for the things that you're obligated to buy through the franchisor, if you're not getting a fair deal, now you have data, you have a third party facts to work on, and that it could be a go-to to improve the overall experience for all the franchisees. Depending on, if it's from a dollar and cents standpoint, if it's material. But never, Kirk, why don't we go right into, you have an easy first step that people, if you're on the call, you're curious, an easy first step to do to see what might be available. Can you walk us through that, and then we'll bring it home and wrap
Yeah,
it up?
well, and people want to know where they can always reach out to Vern and ask and say, hey, tell me about this. But let's suppose you had a manufacturing company called the ABC, and I'm going to give it 15 employees. I'm going to say 0 part-time. This is a very small company. My name is Kirk. This is my thing. I operate in one state. I've never done a tax credit before in my life, or freight or anything. Okay, I might be looking at $26,000 to $104,000 on 15 employees.
Yeah.
If I'm a manufacturer, I've not done any type of audit of any kind, great. You can play with this. This still is in beta. I want to fine tune this a little bit, but let's say now it's 150 employees. Now we can start guaranteeing minimum gains, right? Or let's say you are in healthcare of some kind, okay? We say, please expect a guaranteed 3-year gain of 600 grand if you've got 150 full-time.
Rough order magnitude, just back of the envelope, before you hop on a call, is there some value for me? This tool, we all saw it. It doesn't take but 30 seconds, and it's not the absolute final answer, but it's reasonable.
Yeah, and you might have 150 full-time and 400 part-time in a restaurant business. And then you say, okay, well, looking at maybe $700,000 a year, 700,000 over a 3-year period.
Yeah.
That's the guaranteed minimum. So you can play with that as you like, and then you can discuss the gain. If you want to bring up Vern's contact data, people know how to get in touch with Vern. He can schedule a time, and happy to talk with anyone who wants to go into that deeper.
Yeah. Vern, excellent guy to work with. I'm firsthand. I happen to be in Bethesda, Maryland, outside of DC. If you hear an accent, from Houston, Texas. And Vern and I have known each other for years. What 4 years now, Vern? Something like that.
Yeah, something. Yeah, probably 4 or 5. Yep.
So you definitely want to brainstorm options and find out, what else you can do in your business to make it even better. These cost savings, these tax strategies, it's literally found money. It's fairly immediate payback, and it's a gift that keeps on giving, right? Every year this recurs, month to month continuously, and assume that we're all scaling our business. As you scale, if you 2x, it's roughly, the work you already did is twice as valuable to you. And Kirk's compensation is all performance based. If there's no additional money in the bank account, you're not paying any fees, right? So it's pretty low risk to find out just from the onset how to, from today onward, how to build a better business. And naturally, yeah, we'll definitely send these slides out and for those that you want to hop on something. Naturally, if you want to learn more about, what would be like having a growth CFO, and we do bring in, Vernon and Kirk as our specialists for these exact things. If you want to think about, other things about your business across the full journey from foundation to 7 succession options, it's probably a good idea to have a conversation with me, and we'll kind of brainstorm about what you're shooting for and why those outcomes are really important to you, and then maybe some ideas about how to get there. So that's all I have to say. Vernon, you want to wrap it up for us?
Yeah, well, thanks for your time. It looked like Karen had a question on the cost. There's no cost and no obligation to look at any of the services that we provide. So if you have any interest, please reach out to us, and we'll work with you to see if there's anything that we can do for you and your company to improve cash flow on a consistent basis for you. Yeah. Thank you very much. Appreciate all your time.
And thank you. And see you all soon on the very next event. Thank you. Love your expertise, Kirk. Thank you so much. I love the visuals. And Vernon, thank you.
Thank you.
Adios.
Thanks, Kirk.
Bye.
See you, gentlemen.